All right, welcome everyone. Today, we're going to unlock one of the most powerful tools in all of finance, the balance sheet. Now, I know, it can sound a little intimidating, but trust me, by the end of this, you'll see it's actually just a really clear, simple snapshot of a company's health. So, let's dive right in.
I absolutely love this analogy because it just perfectly gets to the heart of it. Think about it. The income statement, that's your action movie, right? It shows you all the sales, the costs, the profits over a whole period, like a year. But the balance sheet, it just freezes time. It's a single, still photograph showing you exactly where a company stands on one specific day.
And this whole snapshot, this entire financial picture, well, it's all built on one incredibly simple, powerful, and totally unbreakable rule. And I'm not kidding, this is the absolute foundation of all accounting. And here it is. Assets equals liabilities plus equity. This is it. This is the fundamental accounting equation, kind of like the law of gravity for finance. What it's really saying is that everything a company owns had to be paid for somehow, right? It was either paid for with money the company owes to someone else or with money the owners themselves put in. And it always has to balance. Always.
So let's break that down with a super simple example. First up, assets. Put simply, this is just all the stuff a business owns. So imagine we have a little coffee cart business. Its assets are that cart, which is worth $1,000, plus the $500 in cash it has in its bank account. Pretty simple, right? So its total assets are $1,500.
Okay, next up, liabilities. This is everything the business owes to other people. Think of it like outside claims on the company's stuff. So in our coffee cart example, maybe the owner borrowed $600 from a parent to get the whole thing started. Well, that $600 loan, that's a liability.
And that brings us to the last piece of the puzzle, equity. This is what the owner truly owns. It's their personal stake. For our little coffee cart, you just take the $1,500 in assets, subtract the $600 owes, and what's left over? That's the owner's true stake, $900 in equity.
And would you look at that? Our $1,500 in assets on one side equals the $600 in liabilities plus the $900 in equity on the other side. The equation is in perfect harmony. It just works.
But of course, a real balance sheet isn't just three simple numbers. All of this stuff is organized in a very specific way, and it's designed to give us insights at a glance. So let's take a look at how that structure actually works.
Okay, so a standard balance sheet breaks things down into 5 main categories. You can see right away that assets and liabilities are split into 2 groups each, current and non-current. This structure is absolutely key. For instance, under non-current assets, you might see something called PP&E. That's just fancy talk for property, plant, and equipment, while cash is always a current asset. We're about to see why this split is so important. So what's the big difference between current and non-current? It really just boils down to one simple thing, a 1-year time frame. Is an asset probably going to be used up or turned into cash within a year? Yep, then it's a current asset. Is a debt due within 1 year? Well, that's a current liability. Anything with a timeline longer than a year, that falls into the non-current bucket. It's really that simple.
Which, leads us to the obvious question, why? Why bother with this specific structure at all? What's so magical about that 1-year mark?
Well, the whole reason is for something called liquidity analysis. And that's just a fancy term for a really simple, really important question. Can this company pay its bills that are coming due soon? By putting all the current assets, the cash it has or will have soon, right next to its current liabilities, the bills it has to pay soon, you get an instant health check on the company's short-term finances. Now here's where it gets really cool. That still photo we've been talking about, it doesn't just exist in a vacuum. Nope, it is directly changed by the action movie, the income statement. These two things are deeply connected.
So here's how that works. When a company turns a profit at the end of the year, that money doesn't just disappear. That net profit from the income statement flows directly over to the balance sheet, and it lands in a special part of the equity section called retained earnings. And there's the magic link. The action movie of making a profit directly increases the value in the still photo of the balance sheet. This is literally how a profitable company builds its worth over time.
Okay, so before we wrap up, there's one more crucial piece of fine print you have to understand. It's kind of a wrinkle in time, and it can dramatically change how you read a balance sheet.
Here's the catch. A lot of assets on the balance sheet are recorded at what's called their historical cost, meaning what the company paid for them way back when. So imagine a company bought an office building for $100,000 back in 1995. That's the value you'll see on the books today.
But what if its fair value, what it's actually worth today, is $1.5 million? That is a massive, massive difference. And it means the balance sheet could be hiding a huge amount of value. So the balance sheet is an absolutely essential snapshot, but it's a snapshot that's kind of rooted in the past. Which leaves us with a really critical question, doesn't it? If the books only show what was paid for something, how in the world do you figure out what a company is truly worth today?